Hello, I'm James Studinger, financial planner and author of Wealth is a Choice. I believe that wealth is a choice and that we get wealthier by buying things that make money. And I believe that we get poor by buying things that cost money to maintain or depreciate in value. The topic of discussion today is 5 things that you can do in a down market. Over the past quarter century, when I've asked what regrets people have had after a bad market recovered, their answers were unbelievably consistent. Pre-retirees regretted that they didn't buy more shares at low prices, and retirees with regret said that they wished they hadn't sold their shares at low prices. What everyone would like to do, including me, is sell all of our shares at the peak and then buy them all back at the bottom. I'd also like to win the lottery, but neither timing the peak or the bottom of the market or winning the lottery are very realistic. However, that doesn't stop people from trying. The problem with the timing strategy is that it's extremely possible to get it wrong. And if you do, then you could permanently secure losses. It can seem foolish to watch the market fall and do nothing, but historically speaking, it's the more reliable strategy. So here's 5 strategies that you can use in a down market. I list them from what I think are the less risky to the riskier. Number 1, stay the course, provided that you have burn rate coverage. The burn rate is a term I use to calculate how much money someone will spend over a period of years. For a simple math example, let's say a couple takes out $50,000 per year from their investments. Over the coming 5 years, they will withdraw $250,000 of assets. If they hold $250,000 outside the market, then it's highly unlikely they will be forced to sell equities at a loss to pay their bills. That affords them the strategy of riding out a bad market. They won't sell shares at losses, and eventually their shares will recover or even reach new highs. The strategy is to make sure you have enough money not in the market to secure your spending needs. It goes without saying you are always doing a quality check on your investments, no matter if it's a good market or a bad market. And you want to do this to ensure that you are holding appropriate investments. Don't ignore your investments in a downturn, hoping they'll come back to good value. They might not be positioned for recovery, in which case it may make sense to change things around. So always know what you own. Second strategy, convert to a Roth and get more shares for the same money. Let's say you have an IRA with $300,000 in it, and you are considering converting $100,000 into a Roth. The market fell, and now your IRA is worth $200,000. For illustration purposes, let's assume that the account is made up of 1,000 shares of an investment. The investment was originally worth $300 a share. $300 times 1,000 shares is $300,000, and is now worth $200 a share. You still own the 1,000 shares. When they were worth $300 a share, you would have only converted 333 shares to reach a $100,000 conversion. And now you can convert 500 shares into the Roth for the same $100,000. Prior to the market reduction, you would have ended up with $200,000 in a regular IRA and $100,000 in a Roth. Now, assuming the market fully recovers, you will have $150,000 in a regular IRA and $150,000 in the Roth. That's a huge 50% increase to the Roth portion, and it didn't cost you a dime more in taxes than before. We use this strategy frequently, but please note, Roth conversions don't make sense for everyone, and you always need to be aware of the taxes that will need to be paid for converting. The third strategy, capture losses for tax purposes. The trick is to also participate in gains if they come soon. This applies to non-qualified funds. That's money that's not in a tax-deferred retirement account like an IRA or a 401k. It usually is money that's in mutual funds or stocks held in a brokerage account. So let's say you bought $100,000 of an investment and it's now worth $70,000. If you sell the investment, you'll be able to claim those losses to offset future gains. But if you buy back the same investment within 30 days, you won't be able to claim the loss. The trick is in finding an investment that is just as likely to recover as the one that you're selling. Then if the market does recover before the 30 days, you still participate in the gains. This is a strategy we sometimes use depending on the specifics of each client's account and whether I expect to hold a particular investment for a very long period of time. I might keep an investment that I believe I'll hold for many years so I don't reset the basis at a lower number and have to pay more in taxes in the future. The fourth strategy, move to cash. It's tough to know when to get back in and keep with your conviction. With hindsight being 2020, this is what everyone dreams of doing. Trust me, I still reflect on the what-if scenario of selling out of the market completely in the beginning of 2008 and buying back into the market in late of March 2009. The problem with this daydream is buying back in would have been incredibly difficult at the time. The world was falling apart financially, and yet the recovery started quickly and with vigor. Missing that early recovery stage would have been detrimental. When people try to time the market, they tend to buy and sell more often than they anticipated and can lose quite a bit of money in the process. Markets don't typically have a straight fall, a bottom, and then immediately recover. They go up and they go down in massive swings, and they give us plenty of head fakes along the way. Someone thinks they're in recovery because the market goes up massively one day, and so they buy back in. And then the market takes a huge dive later that week, and they freak out and they sell, only to see the market go back up the following week. This bad timing investor dynamic was made famous with the study of Fidelity, measuring the Fidelity Magellan Fund managed by Peter Lynch from 1977 to 1990. Under Peter's management, it averaged an outstanding 29% annual return. However, according to Fidelity, the average Magellan Fund investor lost money during Lynch's reign. All people had to do was stay invested, but they got in and out of his fund and they paid the price. The fifth strategy is to bet against the market, short it. This is wonderful when you get it right, but it can double your losses when you get it wrong. The strategy that's even more risky than getting out and back into the market is to get out and then bet against the market and then get back in. For example, someone might sell their investments when the market is falling and buy an investment that shorts the market, which typically goes up in value when the market falls. This can be very tempting and in hindsight seems so obvious. It also makes people famous when they get it right, like The Big Short, or Michael Burry betting against a subprime loan debacle. Michael ran a hedge fund leading up to the 2008 financial crisis. He believed the credit markets were very messed up and thought at some point there would be a huge correction. He was eventually correct and made tons of money when people around the world were losing money. Unfortunately, very few people get it right, and that's why they're so famous when it happens. And if you get it wrong, then you can lose lots of money on both sides of the trade. So I tend to stick with strategies that historically have proven to not lose money. I'm working with strategies 1, 2, and 3, staying the course, converting to a Roth, capturing losses. I've avoided using methods 4 and 5, going to cash or shorting the market in this environment. I don't know when we will hit the bottom or how long it'll take to get back to previous market highs, but I do believe both will happen eventually. Please call if you have any questions, thoughts, or concerns. I know it's painful to see the value of something be worth less than it was before. We're doing our best to ensure you get back to good value and then some. I believe that sticking with the principles of building wealth is the best way to make this happen. Thank you, and I hope you have a wonderful day.